Number 5 is not reconciling Form 1095A. So let's just go back a little bit into history. Basically, in 2010, there was a Affordable Care Act passed that basically required taxpayers to have healthcare insurance. Otherwise, they would penalize on some of the tax returns in 2006 and 2018. There was a steep penalty if you didn't have healthcare insurance, but you had to. And so there were some qualification criteria. And in 2018, under the Tax Cut and Jobs Act, that was actually removed, reduced to zero. However, you still can receive Form 1095A, B, or C. In the past, you had to bring all of them to tax preparers and show them that you have healthcare coverage. However, now you might still receive 1095B if you have Medicaid, for example, or maybe 1095C, employer coverage. However, you don't need to bring them anymore. The only time you do need to bring them to the tax preparer, or if you're filing yourself, you need to reconcile if you have the 1095A. That's for the marketplace insurance. So what happens if you get that insurance? You can receive advance payments. So what advance payments? Basically, it's like a subsidy towards your healthcare coverage. So let's say if the coverage should be $600, but you're getting a subsidy from the government based on your income and the size of your family and so on, and you get a $300 subsidy, you have to reconcile when you're filing your tax returns. And basically, it does a calculation to basically say, okay, you estimated, because the coverage and the subsidy that you receive is based on what you're estimating your income for that year will be. So I have to estimate today what my income will be for the year. And it may change, right? Especially like with the pandemic, what happened, many people estimated wrong. And so that subsidy is based on that. So at the end of the year, basically, when you're filing your tax returns, you're reconciling and saying, was I right? And if you were wrong, you might have to repay some of it. So that's why you have to file and put that information. And some of the reasons, where the subsidy maybe was calculating wrong, it was because the estimated income was incorrect. There was a change in filing status, household size, employment, and so on. And actually for 2020, for the tax year 2020, the repayment was actually stopped because of the pandemic, and people were completely off because of the situation. No one could, predict any of it. So that repayment was stopped. However, for all other years, like 2021, and I don't know, so far for 2022, it still applies. So that's why when you do file, and let's say if the system finds that you had marketplace insurance, or sometimes people refer to it as Obamacare because it was filed under President Obama, then what happens if the return can be rejected, or you can get a letter later on saying, okay, we know you have marketplace insurance, but you didn't include it on your tax return. So everything can be delayed. So it's very important, if you do have marketplace insurance, to put it in. The only time when it does not matter is if you are paying pretty much everything, like you're not getting any subsidies. So if you're paying everything, there's no reconciliation because you paid everything. So in that case, but if you're getting any kind of subsidies, it can matter. So Taxpayer Advocate Service actually has this estimated to figure out how much in subsidies you could receive based on your situation. I'll put a link in it, so that's very useful. So you can kind of estimate how much you can be required to pay for your healthcare insurance. And there's another resource that I'm going to link, which is basically an IRS website that gives more information about the 1095A form and the premium tax credit that needs to be reconciled on your tax return. One more thing I want to mention is also that even though federally, when you're filing a federal tax return, you're not required to have healthcare coverage any longer, or the penalty basically it's zero. There's still several states that actually do require it. So these are the states that are listed right now on eHealth website, which is Massachusetts, New Jersey, Vermont, California, Rhode Island, District of Columbia. So be aware that even though if for federal tax returns, you're not going to pay a penalty. The states might have different rules. The sixth mistake in our category is not claiming Recovery Rebate Credit, RRC for short. And you're like, what is that? So basically, this is the other side of the coin for the stimulus payment, or otherwise known as economic impact payments, EIPs, which everyone referred to as stimulus payments. So during the pandemic, there were a couple of laws passed, mainly the CARES Act, and another was the American Rescue Plan Act. And basically, they allowed the government to pay stimulus payments, stimulus checks to help with the pandemic and people having no jobs, and to cover their healthcare costs and paying their expenses when they couldn't go to work and so on. And so basically, the American government actually issued 3 stimulus payments. So they're called EIPs, 1, 2, 3, and each of them, to make it confusing, they had different qualification and criteria in order to receive them. And, like for example, the first one had a payment of $1,200 per adult and then $500 per child if the child was below 17. EIP 2 had $600 per adult and child, and EIP 3 had a $1,400 per adult and child, and for any dependent, regardless of age. And then there was also criteria for how much AGI as well as maximum AGI. So it has like a phase out of, when it would start the phase out. So for example, for single, the phase outs would start at $75,000. And for different AIPs, it had the maximum. So if you qualified for this stimulus, however, you didn't receive it. Maybe your filing situation changed because the government used your tax filing information from 2019 and 18, and maybe you didn't file those years. So they couldn't tell whether you qualify for certain things. Maybe you gave birth to a child in 2020, but the government didn't know that. So if your situation changed, maybe you didn't receive, or you didn't receive the full amount because based on your income from prior year, you wouldn't have qualified for the full stimulus payment, but actually you didn't have as much income in the current year. So in that case, you would file the taxes and you would claim the stimulus payment as the RRC, which is Recovery Rebate Credit, on your tax return. And the first payment and the second payment, you could claim it on the tax return for 2020. And the third one you can claim under 2021. Now, that's not necessarily how you receive the payments, but that's how you can receive the recovery rebate credit on your tax return. Now, one good thing with the stimulus payments, these were not taxable. Even, let's say, if you didn't qualify really, but the government used your tax return from prior year and they thought you did, if you receive it, these are not taxable, and you can keep it. They're not going to take it back. And so some people are like, oh my gosh, why did they asking me for if I received the stimulus payment or not, if you're going to file your taxes, or if you're doing it yourself? You might have these questions. Some people are like, oh, are they going to tax me on this money? No, they just want to know. The government wants to know, the IRS wants to know, in order to possibly pay you the recovery rebate credit. However, if you claiming this credit, you're saying, I did not receive it, but you did. Maybe you went to because many of them, they went directly to your checking account. Some could be sent as check, and some could be also sent as debit cards. And some people say, I don't remember receiving it. Well, maybe you didn't review your statements, and there actually was, and you claim it. Then you can delay processing, or maybe you think, oh, my refund is going to be this, but actually the government will send you a letter correcting it, that there was a mistake. There's a website on IRS that has some more information. Now, I just showed you some of the summary because it's kind of overwhelming the way they present this. It's like very hard to read. It's just kind of bad. So I will put the resources here on some information about the RRC payments. This information from Taxpayer Advocate Service, it's much easier to read and clearer. but I also have that summary table that I just showed you. There used to be this get my payment info on a website, but it's no longer available. It kind of like you would be able to double check whether you received the payment or not, but it's no longer available on the IRS website. Like I mentioned, if you think you might have qualified for the stimulus payment but you didn't receive, you want to make sure you do claim it on your tax return. And if that was the case for the past 2 years, you can file for refund up to 3 years. So it's not too late. So for 2020 and 2021, you can still file those returns. If financially it would be hard for you, there are available free resources, VITA program, ARP program, some local city programs, and I'll put a link as well that you can find out where you can maybe get some help filing your back tax returns. The 7th mistake in the list is not repaying first-time homebuyer credit. And these are basically credits that were created by government in 2008 and 2010 during the economic crisis for taxpayers to incentivize them to buy their first home. And basically they would give them a credit, and the credits could range from $6,500 to $8,000. And they have different criteria because there was I think 3 different distinct first-time homebuyer credits. But they would have to repay. Some of them they had to repay, some they didn't. And based on that, every year they would have to file and file Form 5405. So even if you have no filing requirement, but you had the first-time home buyer credit, you would have to fill out this form. And maybe by answering some of these questions, you actually won't have to repay. Maybe the house has been sold. It's 15 years for some people. Could be, 12 years right now, but it's up to 15 years to repay some of these credits and in small amounts. And some of them might not apply, but you're still required to file if you have it. If you're not sure if you have anything to repay, there's actually first-time homebuyer credit account lookup on IRS website, and I'll put a link, and you will just ask you basically to provide your social, your date of birth, and so on to find out, what do you have to repay, if you still have an amount to repay with the IRS. But if you file or you don't file, you might get a letter that, hey, you didn't file your taxes, but you actually have this homebuyer credit repayment that you still have to do. So it's important to be aware, double check your tax return maybe from prior year if you're not sure, to see if that was the case, and just use the account lookup to see, what the IRS has in the system on you currently. 8th mistake is not claiming exception to the 10% penalty for taking money out of your retirement plans. Before you take out money from your retirement plan, you want to really evaluate if that makes sense for you. If you're under 59 and a half and you take out money from your retirement plan, you would be assessed the 10% penalty on early withdrawal, in addition to paying taxes on the withdrawal. Depending on your tax rate, you will pay taxes at that percentage. You also lose future growth potential, and it's also hard to pay back that money to replenish that account to catch up to what you had previously, and you could owe underpayment of taxes if you didn't have anything withheld. Now, this is all true for 401k and traditional IRA. For Roth IRA, you have to have an account at least 5 years, and you can't be under 15 and a half before you could get this penalty. So if you're still below 59 and a half and you take out money early, you would also fall into this category. Now, before you consider taking money out of your retirement plan, think about it, other options. Maybe, for example, you have some investments that you can take money out of because the long-term capital gain is at much lower rate. So, and there's no 10% penalty. So maybe that's something you can consider. And think about it also, the fact that retirement accounts have bankruptcy protection. So that's an asset that you can have in case of bankruptcy that no one can touch. So those are reasons why you want to first think about if you do it, and then if you did do it and you had no other options, then you have to look at the 10% early distribution penalty waivers, because there are many exceptions and there are different ones for 401k and IRA. And let me show you, that's on the IRS website. I'll link it there. And so you have to check what kind of plan you had, and then you can see if maybe you qualify for education exception. Maybe if you use that expenses for qualified education expenses, if it was a traditional IRA, you could use the 10% exception on that. Maybe you bought your new home for home buyers, qualified first-time home buyers. If you have traditional IRA, you could also use the 10% exception, so you wouldn't pay the 10% penalty. For medical reason, another one. So there's many different reasons why you could use that exception, and many times people find themselves that they actually use these funds to cover some of these things. So it's very important. It doesn't really take that much time, especially if you're working with tax professional, or if you're doing it yourself, just Googling a software to find if there are any exceptions to the penalty for taking funds early. Another thing I wanted to mention, okay, so this is like a retirement publication that IRS issues, has more information on distributions when they have the penalty or not. And also if you're filing, amended or prior year tax return for 2020-21, there were some reliefs for taxpayer. There were waivers of required minimum distributions, and additionally, you were able to take out, how much was it, up to $100,000, and waive the 10% penalty. And then you could also report the distribution over, let's say, 3-year period. So if you took the $100,000, you didn't have to put it on your tax return necessarily that year. You could spread it over 3-year period. So there are different rules. So be aware that during the pandemic specifically, there were some reliefs available to the taxpayers. Number 9, missing out on the home sale exclusion of $250,000 per taxpayer. So if you married filing jointly, you can exclude from gain up to $500,000. However, there's some qualification that you have to double check. You have to check you have to pass 2 tests. The ownership test, basically you have to own the home 2 out of the 5 years. Now it doesn't have to be continuous. And you have to also use that home, there's a use test, as your primary residence 2 out of 5 years. If you have 2 homes, you want to double check which one is your primary residence when you're selling it. So it's also important to double check in situations where maybe you're close to the 2 years, maybe you can delay the sale or what have you. So these are things you want to consider. You may receive a Form 1099-S from the IRS, which basically shows the gross proceeds from the sale of the home and so on, which you would have to use to calculate whether or not you have to pay tax on the gain. Now IRS has some information here on reporting the sale and how you qualify and so on. And so there's certain things you want to be aware, like for example a 2-year rule. So if you're selling something close to the 2 years, you want to make sure you will qualify for the exclusion. Now the $250,000, $500,000 gain, that's like a dream thing in situation. Obviously under 2 years, that's going to be very hard to get that gain. However, many people who qualify for this are people who have lived in homes, let's say 20 years and so on. And this is like a good exclusion for them to use. And I have a calculation here how this would be. When you calculate your exclusion, you want to make sure you also include things that you can deduct, because that increases the basis of your home. So if, let's say, I purchase a home for $150,000, now it's selling for $450,000. Now that would be $300,000. So that means $50,000 I would have to pay gain taxes on that gain. However, you want to be aware that you can exclude home cost that you have, did to the house, like improvements, and also some of the fees that you have been charged for selling the home and so on. And so you want to be aware of it, because that will reduce your gain on which you will pay taxes. But this is like an example of basically how to tell and how to reduce that, how much you would pay taxes. Obviously, this is, you have to have records to support these expenses and so on, but it's something to be aware. And also that this actually exclusion, you can take advantage of it number of times. So every 2 years, basically, if you did buy a house and sold a house, but you can take advantage of this exclusion multiple times. And be aware, if you have 2 homes and you're selling one, to make sure you have records to support that that was your primary residence and you lived there at least 2 years. So these are the 9 mistakes that you want to be aware of that have to do with deductions and credits. Thanks so much for watching.